You're listening to Peter Lewis's Money Talk.
Good morning, this is Peter Lewis welcoming you to my podcast Money Talk for Wednesday the 29th of March, and as well as being available on Substack, you can also listen to this programme on iTunes, Google Podcasts and Spotify. In today's headlines, the annual Bao Forum, which is modelled on the World Economic Forum in Davos, which draws hundreds of foreign investors and leaders to China, has kicked off on Hainan. Premier Li Qiang will deliver a keynote speech Thursday. Supply chains and China's connectivity with the rest of the world were in focus at the conference on Tuesday. In a huge shake-up, Alibaba said Tuesday it will split its $220 billion business into 6 groups, each with the ability to raise outside funding and go public. In the most significant reorganisation in the Chinese e-commerce giant's history, each business group will be managed by its own CEO and board of directors to shorten its decision-making process. And shares of Alibaba have soared over 14% in New York following the news. US federal prosecutors alleged Tuesday in a new indictment that FTX co-founder Sam Bankman-Fried paid out tens of millions of dollars in bribes to at least one Chinese government official. The indictment says accounts belonging to Mr. Bankman-Fried's hedge fund, Alameda Research, were frozen by the Chinese police around November 2021. Prosecutors allege that Mr. Bankman-Fried and others directed the transfer of at least $40 million in cryptocurrency to one or more Chinese government officials in order to influence and induce them to unfreeze some of the accounts. Hong Kong's MTR Corporation will increase fares by 2.3% this year in the City Rail operator's first ticket price rise in 4 years. MTR Corp last raised ticket prices in 2019 by 3.3%. And the increase is derived from a new fare adjustment formula that's based largely on the inflation rate and a wage index for transport workers. The increase means that 90% of MTR passengers will have to pay an extra 40 Hong Kong cents per trip at most. On today's programme, I'm joined by personal wealth advisor Enzio von Pfeil and Sunil Kashyap, director of Finmet. With a view from Japan is Tokyo-based journalist and author William Pesek. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com, and where you'll be able to drop me a message or comment on today's programme. And you'll also find there a lot more information about some of the stories discussed on today's programme. On Wall Street on Tuesday, bond yields rose for the second day in a row, with the rate on the 2-year US Treasury notes rising back above 4%, putting pressure on stocks and tech names in particular. The yield on 10-year Treasuries advanced 3 basis points to 3.57%. The uptick in rates was a headwind for the tech-heavy Nasdaq, which shed 0.5% to close at 11,716. The S&P 500 fell 0.2%, ending at 3,971. The Dow lost 38 points, or 0.1%, and closed at 32,394. The Nasdaq Golden Dragon Index of US-listed Chinese shares closed 3.5% higher, boosted by shares of Alibaba and BYD. Alibaba surged over 14% following the news of its reorganisation, and shares of EV maker BYD jumped over 4% after the company reported net income soared 446% in 2022 to about $2.4 billion after the Chinese automaker sold a record number of electric vehicles. Asian equities advanced on Tuesday as investors become increasingly confident that the global banking sector turmoil could be contained after regulators confirmed First Citizen Bank would buy much of the collapsed Silicon Valley Bank. In Hong Kong, the Hang Seng Index climbed 217 points, or 1.1%, to 19,785. And this morning, the Hang Seng is projected to open around 110 points higher on that Alibaba news. The tech index added 0.9%. On the mainland, the Shanghai Composite was down 0.2% at 3,245. Elsewhere in the markets, the US dollar fell to an 8-week low against a basket of currencies, and Brent crude oil settled 0.7% higher. And you can get more details on the latest market movements on my daily blog at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk.
And let's go and join our guests. We have with us Enzio von Pfeil, wealth investment strategist. Very good morning to you, Enzio.
Morning to you, Peter.
And also with us, sitting in the other studio next to me, is Sunil Kashyap, who is director of Finmet. Morning to you, Sunil.
Good morning, Peter, and good morning, Enzio.
Let's start with the Bauern Forum. It's modelled on the World Economic Forum in Davos. It draws hundreds of foreign investors and leaders to China. It's kicked off on the Chinese island of Hainan, and the conference is going to be held until March the 31st in Bao, Hainan, under the theme An Uncertain World, Solidarity and Cooperation for Development Amid Challenges. That's the name of the conference. Premier Li Qiang is going to deliver a keynote speech Thursday. Supply chains and China's connectivity with the rest of the world were in focus at the conference on Tuesday. Enzio, we've seen at this conference and also at the Beijing one over the weekend, a lot of government officials talking about how business friendly they're going to be, how they want to attract private companies and particularly overseas companies, including US companies, to come to China. Are overseas companies listening, do you think?
Well, I think they're listening, but they're probably a little bit wary because if Xi Jinping, as he is very much stressing the role of the party, which is totally legitimate that he's doing this, then I think that you'll find a lot of wariness as about sort of really investing in China and maybe yet again having to give away all of the technological secrets that they have. So. But I think at the end of the day, these companies have to what I call recouple with China, not decouple, not couple, but recouple with China, because the level of demand in China, the sophistication of demand in China has changed a great deal, and they have to keep abreast of that.
And companies are going to have multiple locations anyway for their supply chains, aren't they? It's going to be a different sort of supply chain arrangement. It's not just going to be one.
Yeah, division of labor.
Yeah, and I think
so.
I think you're... Go ahead.
No. So what I'm suggesting is that the more sophisticated the demand in China gets, the more they will have to divide the labor between, say, Vietnam, China, Indonesia, etc. But Sunil, please, over to you.
No, I agree. I think it's also not only about the demand in China, but also the fact is that during the COVID period, a lot of companies did go overseas. They did try to set up, they have set up production facilities in Cambodia, for example, or Vietnam, but the experience hasn't been very good. And so I think everyone does realize that the infrastructure that China has, the network of suppliers that it has for different products, makes it far better than any other place. So the re-engagement with the foreign companies, I think, is a sort of win-win situation for everyone, because it helps bring them back and be confident about going back to the old situation. Perhaps with caution, and like you said, they'll be wary, so they wouldn't ramp up production back to the same levels they had earlier. But at least the lion's share will still go back into China.
Yes.
It seems to have changed, doesn't it? It's not just about anymore investing in Chinese manufacturing companies, multinational firms. They want a sort of more mutually beneficial business cooperation, because the global economy is linked, obviously, to these big sort of firms. So it's a lot more about commercial collaboration, isn't it? And making sure, as you say, Sunil, it's a win-win situation.
Yes, and but I think Enzio mentioned the right thing. I think in the past, what will be different compared to now? In the past, companies were much more open in terms of sharing some of their trade secrets, some of their IP, some of their technology. I think the companies now will be a bit more careful that if there's any cutting-edge products, if there's any new research that they have, they'll be more wary about bringing it into China compared to the past.
Enzio, there's a lot of talk about opening the economy to sort of foreign investors. Premier Li said that China's going to remain open no matter what happens. Is it sort of trying to send out a different message? Because it really is banging on this particular drum at the moment, isn't it? About how open it is to foreign companies, how much private businesses are going to be welcome. Is this a real change in tune? Because private businesses have been under the thumb rather a lot, haven't they, over the last couple of years?
There's an old Latin saying that hunger is the best seasoning. I think that the local government finances in China are so appalling that the government knows that it has to actually create revenue and jobs in China itself at a local state and county level to get these things going again. And I think that that's not totally divorced from this whole, what I call the recoupling of China.
It seems even that local governments in some cases are actually helping their own companies sort of retool overseas in places like Vietnam, because, as you say, they need to get these businesses up and running and get them growing.
Well, and also it's just that the demand structures have changed. I mean, the richer a country gets, surprise, surprise, the more sophisticated its demand becomes. When I was doing my doctorate in Germany on multinationals going to the U.S., German multinationals, it became very clear it was not a matter of saving on labor costs, but it was very much on staying on the ball with American consumers' demand, and then being able to shift supply chains and production really at the flick of a finger. So that's what I think is behind this whole interest of foreigners going into China.
I think also that the reason why China is trying to attract foreigners is also for capital. Clearly there's been a lot of destruction of capital and also foreign capital into China over the last couple of years. And I think the Chinese have found that they need foreign capital in for example, in real estate or in their capital markets. There's been really no development in the capital markets for the last 5 years or so. And so I think they do realize they need the expertise the foreign entities bring in, and also the capital that they bring in to help support the growth of the economy.
Building on Sunil's point, the last one, over 50% of the local government financing vehicles, bonds, are now unrated, over 50%, which is a huge number of the buyer just doesn't know what he or she is getting into anymore. That shows you the desperation of how much money they need.
And it's all very well and good, though, all this talk about opening up. But the problem is it's coming at a time when China's facing a very sort of uncertain global economic outlook. And also it's facing all these restrictions from the US government on exports of technology to Chinese companies. How does it overcome that?
Well, let me go first. I think that the key is that the Chinese, in true Chinese fashion, I think, are wanting to pit the business community of America against the government community of America. So in other words, you get all these bureaucrats saying, we don't want this, we don't want this, we don't want this. And the business community is crying out loud saying, but we want to go into China, we want to do this, we want to do that. So I think that's where the real tug of war is. All domestics are politics, or all politics are domestic, and I think that's very much the case with China on this direct investment stuff.
Yeah, but it's more risky. I mean, the environment now is different from the environment 5 years ago. So you're right, Enzio. They've done this in the past, and the rush of making profits and corporate profits made these companies influence Washington to pass pro-China policies, or at least not pass anti-China policies. But the mood has changed, and I think there's no appetite at all for any kind of conciliatory kind of a tone. So I think the U.S. corporates now actually have a very difficult time in terms of trying to balance the mood in Washington, balance the signals from Beijing, and also trying to optimize their bottom lines. So it's much more difficult. You can see even the way Tim Cook's trip is panning out. He's so careful about the interviews he gives. He's so careful about what he says. And that's the kind of scenario we're in. A lot of the CEOs have not even given any interviews. You can't see them on TV. They're there, but they don't want to appear in front of the media. So it's a very different environment now, and it's extremely complicated for a corporate CEO and a corporation, U.S. corporation, to figure out how to create a balance between what Beijing wants and what Washington wants.
Now, in a huge shake-up, Alibaba said Tuesday it will split its $220 billion company into 6 business groups, each with the ability to raise outside funding and go public, in the most significant reorganization in the Chinese e-commerce giant's history. And each business group is going to be managed by its own CEO and board of directors to shorten its decision-making process. Enzio, how significant is this? It's clearly the government is behind it as well, isn't it? Because Alibaba and Tencent and other tech companies have really been under pressure to go and reorganize. But is this the right thing to do?
Well, I think it's the classical divide and rule, an old Roman war technique. And so I think that the government in China, from what I read months and months ago, was getting a little bit not scared, but just nervous about the power of some of these behemoths in China, and it wanted to control some of their news flow and their just their tech flow. So I kind of get it from the government perspective. Maybe there will be more synergy effects within Alibaba because you will be using more and more sort of smaller outfits to create ideas. So it doesn't sound all bad to me.
Yeah, there's 2 points. I think two ways to look at this. Firstly, I think from the general economy point of view and policy, it's interesting for me that we've seemed to have come full circle. If you recall, the whole change in the party's view about private enterprise started with the refusal to allow the Ant IPO. Mm. And then, you had a succession of things where Jack Ma left, etc., etc. And now you're sort of reversing that. Jack Ma's back. The Ant IPO is back on again with this restructuring. And so I think they're trying to now go back to where they were and try to rectify some of the mistakes they made as far as the view towards the private sector. So that's as far as the government is concerned. As far as Alibaba is concerned, I think, if you look at just the history in terms of corporate history in the US, clearly when you have a situation where a corporation becomes too big, a la GE, it becomes difficult to manage and decision making becomes difficult. So just from a optimization point of view and enhanced value for shareholders, this breakup makes sense because each of these divisions in themselves are going to be very big companies, and so that's why the stock price has gone up because net yes. It's going to be good for shareholders.
Presumably this is a model that could be used for other companies. I mean, Tencent springs to mind, and even outside of China, like Alphabet, for example. If you have these huge tech giants, which governments sort of want to reduce the monopolistic nature of these companies, maybe this is the model for elsewhere.
Enzio?
I think so. I think that's probably what's going to happen. And again, I think it's very much this political force of the government, quite understandably saying, I don't want these companies getting so powerful that they actually run us in Beijing or even at a local level. So I get the logic of this. And also with what Sunil was saying, there will probably be more synergy effects precisely because small is better than one big glob.
Now, moving on, US Treasuries sold off on Monday and Tuesday as investors' concerns over the banking sector eased. The yield on the policy-sensitive 2-year US Treasury was up 7 basis points to 4.09%, although it's still trading close to 100 basis points below the Fed funds rate. Sunil, it's a chance to get your thoughts, actually, on the banking crisis and where you think we are in it. Are we almost at the end of it, or what do you think?
I wouldn't call it a banking crisis. I mean, that's what I think for the last few days people have been calling it a crisis. It's not a crisis. It was informational contagion, if you want. There was just a contagion. To me, it reminded me of our own experience during COVID. And you remember the run we had on toilet paper?
Yes.
Right? It was similar to that. It just didn't make sense. And it's just because the rumor spread that there's not going to be any toilet paper, people went out and got it. And so I think you had the same situation. What's unfolding right now is clearly there were a few banks which could have been managed better, but they were nowhere near a situation where they were close to failure. But the run, I mean, overnight there was interesting information that came out that SVB Bank would have lost 100% of their deposits in 2 days.
Yes, they lost almost 80% in 2 days, and if they'd lasted another day, it would have all gone.
So imagine, that's never happened in the past. And so I think, no bank can sustain that. So firstly, I would say it's not a banking crisis, right? If you wish, it was a situation where social media created this run, and we still have that fear. We saw that last week with Deutsche Bank, where somebody shorted some CDSs, and somebody bought CDSs and then went out and spread rumors about Deutsche Bank. And so you do have these market manipulators who are unfortunately using markets and social media to try and maximize their profits. And so that creates a situation. I think in that sense, this is a new event risk that's happened for banks. And now the regulators and the banks have to digest it and face it. But it's not a crisis in terms of any traditional bank failure kind of situation.
Enzio, do you give good marks for the regulators for how they've handled this, and the US Treasury and governments?
Well, for the big banks and for SVB, of course, because they've put their finger in the dike and they've kept it from completely flooding. But again, one can't have too many Band-Aids. I think actually that overall you will find more bank leeriness when it comes to lending because of the perhaps higher risks beginning to make themselves felt in the U.S. economy. Certainly, if the lending rates rise because of a mild credit crunch, then it's people who are thinking that rates are going to fall or being a little bit sloppy with their terms. Perhaps the Fed funds rate, I don't think will fall. I think it will get stuck perhaps now at 5.5, not at 6 is what I was saying before. But I think that the lending rates will pick up, and that means that the bond yields that the bond prices have to go down because they won't like these higher long rates.
I agree. I think what's happening is the markets are in some sort of a tantrum where they don't want to believe reality, and it takes time to adjust to that, and that's what you're going to see over the next few weeks.
So you don't believe that the markets at one point were pricing in 100 basis points of rate cuts by the end of the year? I mean, they say you shouldn't fight the bond markets and you shouldn't fight the Fed, but one of them's got to be wrong here, isn't it?
Yeah, I mean, they flip every day. I mean, you've seen huge volatility in bonds, and so it just reflects the fact that people don't have a view which is beyond a trading day. Right, so they're just taking the bond traders are just taking views, just watching the momentum and following trading on that basis. So I wouldn't put too much merit into what you see in the markets nowadays.
Just to illustrate what he was saying, what Sunil was saying, in March the punters figured that the Fed funds would peak at 5.75% this December. Now they're saying 4%. Well, that's quite a severe change of mind.
And the flow of data hasn't changed. The actual what governs Fed policy is inflation data, economic data. The trend of that economic data hasn't changed. Yes. So these guys have just tried to read Fed's mind without any basis, and you can see the flip flop they've done. So
huge volatility, isn't it? Absolutely unbelievable volatility in the bond markets. Before you go, I want to ask you about Hong Kong's new measures to attract family offices here. They rolled out several new measures now to try and attract wealthy investors and family offices to the city. They include things like profits tax exemption for single family offices, a new investment migration scheme, the setting up of even new art storage facilities at the international airport. Enzio, I've got an email from a listener to this programme, from John Grove, who's chairman of Grove Industries. He said there's lots of talk in the press on family offices being courted to set up in Hong Kong. Perhaps you might comment on your show. And he says one thing that comes to mind was lots of wealthy individuals have moved their accounts to Singapore in recent years to ensure it's safe, although their accounts are still managed in Hong Kong. So how do you get reassurances to convince family offices their money is safe in Hong Kong with the concerns over what China might or might not do in the future?
Well, I think John's question is very typically trenchant, but I think that the result will be that you'll find more of the money being managed, the money actually physically sitting in Singapore, but the management of that money, seeing the opportunities in the Greater Bay Area, the joint venture, the VC, and all that kind of stuff, that will remain in Hong Kong. And I think, again, like with the direct investors, these family offices want to keep their ears close to the ground to see what's happening here, but that doesn't mean that they have to put their money in Hong Kong. They can actually have it run via Singapore companies.
That's right. I think, Enzio, I mean, it's important to distinguish the capital markets in Hong Kong from the capital markets in Singapore. The Singapore markets tend to be more the basic markets, FX, bonds, fixed income, and to some extent commodities. Whereas Hong Kong has a very strong ecosystem in terms of private equity, equities, equity finance, etc. And I think that's why, and this is where the deals are done in terms of corporate finance, especially for the mainland. And so that's why I think the for somebody making decisions in terms of investment, it's vital to be in Hong Kong. The fact whether you'd like to have your money here versus Singapore is exactly what Enzio said. I agree with that.
Well, thank you both very much. You heard there Sunil Kashyap, who is director of Finmet and wealth investment strategist and our regular commentator on this programme, Enzio von Pfeil.
You're listening to Peter Lewis's Money Talk.
Joining me now on the phone from New York is normally Tokyo-based journalist and author William Pesek, but over stateside this morning. Good morning, William, or good evening to you, I should say.
Good evening, Peter. Great to be here.
Thank you for joining us. Let me ask you about how the banking crisis, I've been told this morning I shouldn't really use the word crisis, but what's been going on in the banking sector, how that's been impacting Japan.
Well, I think it's perfectly legitimate to call it a crisis. I think here in Japan, it has not reached crisis levels, but certainly globally, I think this is certainly the biggest shock to the global system since at least 2013 during the taper tantrum, and certainly since 2008. And I think in many ways in Japan they're watching and waiting, but there's a great deal of trepidation here for a couple of reasons. One, of course, there's been a lot of speculation about the Bank of Japan stepping away from quantitative easing. I think that is now off the table. And in the next week or so, you'll have a new BOJ governor, Governor Ueda, arriving at Bank of Japan headquarters. And a month ago, when he first got the job, his role, it seemed to be to begin wrapping up quantitative easing. And now, if you look at the signals coming out of the Bank of Japan, the BOJ might be on hold for longer than expected and might even need to increase liquidity given what's going on in the global economy. And the other issue is that Japan has more than 100 regional banks. For years now, the government's been trying to get these banks to consolidate, to increase efficiency, to increase digitalization, because they're basically arrayed around the country in these aging and shrinking communities. And a lot of these community banks look very kind of Silicon Valley Bank-esque in terms of their customer bases, in terms of the fact that they make all their money mostly from buying government bonds, not making loans. And so I think here in Japan, there's a lot of worries, not that the crisis will come here exactly, but that the feedback from the crisis will change the economic trajectory here quite a bit.
The problem with banks like Silicon Valley Bank was not so much that it was holding so many government bonds, it's that it didn't hedge the interest rate risk on them. So it was sort of mismanaged. How do you know? I mean, in the Japanese banking system, clearly, in many ways, they hold even more government bonds than US banks do, because yields, interest rates are so low there that they've got to stock up on these US government bonds. How do we know whether or not, there's problems lurking in some of these banks?
I mean, that's exactly the issue that you just raised here. One of the things is that Japan has had quantitative easing for more than 20 years now. And I think in many ways, Japanese banks have forgotten how to hedge against rising interest rates. I mean, here in Japan, when 10-year bond yields rise, basically a quarter of a percentage point, you see the financial system flinch a bit. And so I think in many ways, Japan is greatly worried about the extent to which rising yields could be a shock to the system. And I don't think that banks here generally have done a very good job of hedging, simply because they haven't had to in a very, very long time. And so if you do see 10-year yields, rise above 0.5%, towards 1%, towards 2%, that will be quite a shock to the system here in Japan.
So it could be then, as Warren Buffett says, when the tide goes out, you find out who's not wearing a bathing suit. We could find out which Japanese banking executives weren't wearing their bathing suits.
It's funny. It's great minds thinking alike. I actually wrote a Forbes column 10 days ago using that very headline.
Now, the other thing I wanted to ask you about, William, is Japan-China relations. A lot of focus in recent weeks and months on China-US relations. But what about Japan-China? Because we had a week ago these very interesting optics of President Xi Jinping in Moscow. With Vladimir Putin, and then at the same time, Prime Minister Fumio Kishida in Kiev with the president of Ukraine. Very interesting contrast, wasn't it? But I'm wondering, what is the state of Japan-China relations? They must be, I would have thought, a bit worried about things like this developing relationship between China and Russia, which in effect stretches across the whole of sort of Eurasia now, doesn't it?
That's true. I mean, it was quite a split screen recently where you basically had Xi Jinping visiting Vladimir Putin, and you had Prime Minister Kishida over in Ukraine, in Kyiv with President the president of Ukraine. And I think in many ways that was a very interesting moment where you looked at these different split screens. But Japan is certainly very wary of the ways in which China is cozying up to Russia. And it's funny, Prime Minister Kishida, he is much less of a nationalist than, say, Prime Minister Abe was. So I think early on, there was some hope that there will be somewhat of a détente between Japan and China, and Japan and South Korea as well, over the last couple of years. I think you've seen more of that between Japan and South Korea. But to me, at the moment, Japan and China are as far apart as they've been at any time in the last 10 years. And I don't really see a lot of appetite for improving ties here in Japan. In fact, if anything, you've seen during the Kishida era, you've seen Japan pivot more and more towards the U.S. I think that Prime Minister Kishida views Joe Biden in the White House as a much more reliable partner than Tokyo considered, say, Donald Trump in the past. And so I think, if anything, the U.S.-Japan alliance is growing very much stronger as we speak. And the Japan-China alliance, there isn't much to it. I mean, commercially, it's certainly there. I mean, China is Japan's biggest trading partner by a long way. But in terms of diplomatic relations, things are really, really kind of frozen.
I mean, those television pictures really showed which side both countries were picking, didn't they? I mean, clearly China is putting its lot in with Russia. Fumio Kishida is putting his lot in with President Biden and the US's Western allies.
Right. And, again, you look at Prime Minister Kishida over there with President Zelensky. I think a lot of Japanese felt a lot of pride when that happened. I think one of the interesting things about Prime Minister Kishida is he was very quick to ally with the U.S. effort in Ukraine. And I think for many Japanese, that was a source of pride. And early on, that gave Prime Minister Kishida a nice bump in his approval ratings. That's kind of waned since then. I mean, Kishida's approval ratings now are back in the mid-20s, partly because the economy is not doing as well as hoped. And I think in many ways, hopes that Kishida would accelerate economic reforms haven't really worked out as hoped. But you're right. I mean, that split screen, it has made for some fascinating geopolitical dynamics.
And I suppose we shouldn't underestimate just how significant and unusual that visit was, because it's the first time that a Japanese prime minister has visited a country that's at war since the Second World War itself.
Indeed. No, it was very surprising. And I think for Prime Minister Kishida, it was absolutely the right thing to do. I think, I'm not mistaken, that means that all leaders of G7 nations have been to Ukraine at this point. And I think Japan might have been arguably the last one. So I think in terms of closing the circle, that was a step in the right direction. And I think also at a moment where you see China cozying up to Russia, it was Japan's way of reminding Xi Jinping that at the moment, Japan finds a lot more partnership with the West than it does with China.
And what is this issue about a Japanese man who's been detained in Beijing since earlier this month of allegedly spying? He's an employee of Astellas Pharmaceuticals, isn't he? What is that getting a lot of publicity, a lot of attention in Japan? Because I know that Japan's foreign ministry has demanded that he be released straight away.
Yes, it's gotten a lot of attention. I mean, China according to the official government numbers, China has detained at least 17 Japanese nationals on alleged espionage since about 2015. And in very, very few of these cases have the Chinese been able to explain with any, credibility that the allegations are real. And I think in many ways this is a reminder that relations between China and Japan, both politically and commercially, are very tenuous. And I think that there's a lot of skepticism here in Japan, or over in Japan, that this arrest is a credible arrest and that it's a good one. And I think certainly the extent to which you've seen, basically the chief cabinet secretary and the foreign minister working overtime to find out from the Chinese exactly what gives suggests the extent to which Japan is not going to take this one lying down. And it will be interesting to see if Japan does consider any kind of steps, sanctions, if you will. But I think this is a bigger deal than more recent stories over the last 5 years of Japanese nationals suddenly being arrested in China. So we'll see.
William, thank you very much indeed.
Thank you, Peter.
That's William Pesek, Tokyo-based journalist and author. Well, thank you for listening this morning. Please let me know what you think about the programme by going over to peterlewismoneytalk.substack.com and commenting there, or you can also send me a message as well. I'll be back tomorrow morning when my guests will be Andrew Ferris, the CEO of Econosis Advisory, and Christopher Lee, Senior Partner at Farron, Augustine and Alexander Investments. And with a view from South Korea is Peter Kim, who is Managing Director and Investment Strategist at KB Securities. See you tomorrow.
Money Talk.